For over a decade, the financial world has been a stage for a very specific type of star. The visionary founder, the disruptive technology, the promise of exponential growth tomorrow, funded by zero interest capital today. We were told that traditional metrics were obsolete, that cash flow was a quaint relic, and that the only thing that mattered was capturing market share at any cost. And for a while it worked. The darlings of Silicon Valley and the high-flying growth stocks delivered returns that made the old guard look, for lack of a better word, obsolete. Meanwhile, in Omaha, Nebraska, Warren Buffett continued to do what he's always done. He bought railroads, insurance companies, banks, and an inexplicable amount of Coca-Cola. His portfolio, the bedrock of Berkshire Hathaway, was derided as a museum of 20th century industry. It was boring, it was unsexy, and for long stretches it underperformed. Commentators asked if the oracle had lost his touch, if value investing itself was a dead philosophy in a new technological age. Today, we're here to argue that the reports of its death were greatly exaggerated. We are on the precipice of an unsexy comeback, a paradigm shift where the very principles that made Buffett's portfolio seem antiquated are precisely what make it positioned to outperform in the decade to come. This isn't a nostalgic appeal to a bygone era. It's a cold, hard look at the changing mechanics of the market. The tide of cheap money has gone out, and we are about to find out who has been swimming naked. To understand why these boring investments are poised for a renaissance, we first need to recalibrate our definition of boring. In the context of Warren Buffett, boring is a synonym for predictable. It signifies a business with a durable competitive advantage, what he famously terms an economic moat. This isn't just about brand recognition, it's about structural advantages that are profoundly difficult for competitors to overcome. Consider BNSF Railway. You simply cannot build another transcontinental railroad across the United States. The rights of way, the capital expenditure, the regulatory hurdles, it's a practical impossibility. That is a moat forged from steel and geography. It provides immense pricing power and generates predictable, inflation-resistant cash flow year after year. Or look at American Express. Its moat is a closed-loop network effect. It attracts high-spending cardholders, which in turn attracts merchants who want access to those cardholders, creating a virtuous cycle that is incredibly difficult for a new entrant to break. These businesses don't promise to triple their revenue next year. They don't have a total addressable market of the entire planet. What they have is a claim on a small but highly defensible slice of the economic pie. And in a world of rising uncertainty, predictability is the most valuable commodity of all. The core of the value investing philosophy is not just buying cheap stocks. It's buying wonderful businesses at a fair price. The first step is identifying that wonderfulness in the form of an economic moat that ensures the company's long-term survival and profitability. The focus is on resilient, gushing cash flow, not speculative stories. Now, let's address the elephant in the room, the macroeconomic environment. For the better part of 15 years, we operated under a ZIRP regime, a zero interest rate policy. When the cost of capital is effectively zero, the laws of financial gravity are suspended. $1 of potential profit 10 years from now is worth almost as much as $1 of profit today. This environment is a paradise for growth stocks. It allows investors to justify stratospheric valuations for companies with compelling stories, but little to no current earnings. The discounted cash flow model, the bedrock of intrinsic value calculation, becomes hypersensitive to long-term growth assumptions and minimally sensitive to current cash generation. That era is definitively over. With central banks globally raising rates to combat inflation, the discount rate, the R in your DCF calculation, has increased dramatically. This has a brutal and non-linear effect on valuations. A company that generates $1 billion in free cash flow today is hurt far less by a higher discount rate than a company that hopes to generate $1 billion in free cash flow in 2035. The future is being discounted more heavily. The present has become paramount. Suddenly, those boring companies with their predictable, robust, and immediate cash flow look incredibly attractive. Their intrinsic value is less dependent on rosy projections about a distant future, and more anchored in the tangible reality of their current operations. This isn't an opinion, it's a mathematical certainty. The great re-rating we've witnessed, where high-growth tech has been punished while value-oriented sectors have held up, is a direct consequence of this fundamental shift in the cost of capital. Warren Buffett's lifelong focus on what a business is worth today was not a bug. It was a feature that was temporarily masked by an unprecedented monetary experiment. Financial discipline, once seen as a constraint on growth, is now being recognized as a prerequisite for survival. If this scenario feels vaguely familiar, it should. We need only turn the clock back to the late 1990s. The parallels are almost uncanny. Then, as in recent years, the market was captivated by a narrative of technological revolution, the dot-com boom. Companies with com in their name but no profits, no viable business model, and often no revenue, were reaching valuations that dwarfed established industrial giants. And where was Berkshire Hathaway? It was on the sidelines, ridiculed for its refusal to participate. Barron's ran a scathing cover story in 1999 titled, "What's Wrong, Warren?" Berkshire's stock was lagging the S&P 500 significantly. In his 1999 shareholder letter, Buffett himself acknowledged the underperformance, writing, "It's been an unusual year. The combination of a surging stock market and a flat price for Berkshire shares has resulted in our worst performance, by a huge margin. Let's look at the numbers. In 1999, the S&P 500, fueled by the tech bubble, returned a staggering 21%. Berkshire Hathaway stock lost 19.9%. The critics were howling. But what happened next is the crucial lesson for today's investors. The bubble burst. In the year 2000, the S&P 500 fell by 9.1%. Berkshire Hathaway gained 26.6%. In 2001, as the carnage continued and the S&P 500 dropped another 11.9%, Berkshire was up 6.5%. The market cycle had turned, and the principles of value investing reasserted their dominance. The unsexy had its comeback. Buffett wasn't a market timer. He simply continued to apply his long-term investing principles, refusing to overpay for assets, even when it meant looking foolish in the short term. He focused on intrinsic value while the rest of the world was chasing momentum. This historical precedent provides a powerful roadmap for the current environment. The pain felt by speculative assets in 2022 and 2023 is not an anomaly. It's a reversion to the mean. This brings us to Buffett's modern capital allocation, which demonstrates that his principles are not static, but are applied to the opportunities of the day. Over the past few years, one of Berkshire's most significant moves has been its massive investment in the energy sector, particularly in Occidental Petroleum and Chevron. To a market obsessed with ESG and renewable energy narratives, this looks like another boring, backward-looking bet. But look closer, and you'll see the classic Buffett playbook in action. What do these energy giants offer? First, enormous tangible assets that are impossible to replicate and essential to the global economy. Second, in a world of elevated energy prices, they are generating monumental free cash flow. Third, and this is critical, their management teams have embraced financial discipline. Instead of plowing every dollar into speculative new drilling projects, the mistake of past cycles, they are returning immense amounts of capital to shareholders through dividends and buybacks. They are maximizing shareholder value. This is the antithesis of the growth at all costs mindset. It is a calculated investment in companies that are trading at low multiples of their earnings, have tangible asset backing, and are rewarding owners with cold, hard cash. Buffett's energy play isn't a bet on the oil price tomorrow. It's an investment in the cash-generating power and newfound capital allocation discipline of an essential industry that had fallen out of favor. It proves that value investing isn't about buying buggy whip manufacturers. It's about finding value wherever it exists, even in the most unsexy corners of the market. So how does a professional investor apply these lessons without simply trying to mimic Berkshire's portfolio? The key takeaway is not what Buffett buys, but how he thinks. It's about re-anchoring your investment framework to a few core, timeless principles. First, prioritize businesses with demonstrable economic moats. In an inflationary environment, a company's ability to raise prices without losing customers, its pricing power, is its single most important defense. This power is a direct result of its moat. Ask yourself, can this business be easily replicated? Does it have a captive customer base? Is it a low-cost producer? Second, develop an obsession with cash flow. Look beyond narratives and revenue growth projections. Analyze a company's ability to consistently generate cash from its operations. Free cash flow is the lifeblood that allows a company to pay dividends, buy back shares, and reinvest in its business without relying on fickle capital markets. Third, insist on rational capital allocation. Study how management uses that cash flow. Are they engaging in value-destructive, empire-building acquisitions at the top of the market cycle? Or are they returning capital to shareholders when they can't find internal projects that meet a high return threshold? A CEO's primary job is capital allocation, and their track record is a critical piece of due diligence. Finally, and most importantly, exercise price discipline. As Buffett says, price is what you pay, value is what you get. The greatest business in the world can be a terrible investment if you overpay for it. In a higher interest rate world, the margin of safety, the gap between the price you pay and your conservative estimate of intrinsic value, is more crucial than ever. The era that glorified disruption above all else is drawing to a close. It was an exciting time, but it was fueled by an economic anomaly. We are now entering a period that will reward resilience, profitability, and discipline. The market is shifting its focus from speculating on the future to valuing the present. The boring investments that populate Berkshire Hathaway's portfolio, the insurers, the railroads, the consumer staples, the cash-gushing energy producers, are built for this new reality. They are not exciting. They will not be the subject of breathless headlines.